All right, so today we're going to talk about lecture note 3, which is the EIC Framework. Stands for Economy, Industry, Company. EIC. General idea of this framework is that about half of a company's performance is going to be based on external factors. These are the three major external factors that we're going to look at. One is the economy, 2 is the industry performance, industry rules, and 3 is whether or not the company has competitive advantage, are going to determine a lot of a company's profitability and therefore its ability to earn a return on investment. So we're going to start out with the E part of the framework, which is the economy. So when we do economic analysis in this class, what we're going to care about are really two things. One, how sensitive is a company to changes in the economy? And so 2, we need to know what's going to happen to the economy. So those are really the two things we need to assess as part of the E framework. So I'm going to start out with that second part, which is how sensitive, what is going to happen to the economy on a go-forward basis. And so what we're going to do to help us answer that question is we're going to use data from a website called the Conference Board. The Conference Board is a DC and New York-based, basically economic think tank. And there's many of these out there. It's the Conference Board, the one we're just going to arbitrarily choose to use this class. And their website is conference-board.org. Don't go to conferenceboard.com. I think it's a porn site. So conference-board.org is their actual website. And on or about the 24th of every month, they publish a press release with 3 sets of economic indicators. The LEI, which stands for the leading economic indicators, the CEI, the coincident economic indicators, and the lagging index, lagging economic indicators. And basically, they help us understand the overall direction of the economy. So, here is the latest chart of the LEI from the Conference Board. And you can see on the bullet points on this slide, this is the factors that make up the index. Matter of fact, if you want to see on their site, they give more explanations in the weighting. But the general idea is this blue line represents the LEI index over time. The gray bars represent historical recessions. And so the general idea of the LEI is this index tends to start trending downward before we have recessions. And the index starts trending upward before recessions end, signaling troughs and therefore the bottoms of recessions. So when the LEI is moving up, it tends to mean economic performance is getting better. When the LEI is trending down, it means it's getting worse. And generally, it's predictive about 2 to 3 quarters in advance. So it's really looking out about 6 to 9 months. So right now, and you can see since our last recession, the LEI has been generally trending upward. And this has been the economic expansion that the economy has been in. And because the economic expansion is tepid, people pay a lot of attention to this index every month to see if that LEI starts trending down. And if it does, they get really nervous. So basically, these are the key to the LEI index, as opposed to the coincident index. So if you go to the coincident indicators, the coincident index tends to start going down as the economy enters a recession, and it starts to go up as the economy leaves the recession. So again, the CEI basically tends to move more with the economy. And finally, the lagging index. The lagging index tends to go down after we're in a recession, and the lagging index tends to go up well after recessions have ended. Hence, the lagging nature of the index. As a matter of fact, one of the factors in the lagging index is unemployment. So you can think about that. Basically, as we go into bad times, companies wait until they really know they're bad times before they start getting rid of people. And then even when the economy rebounds, companies start to wait to make sure the economy's really rebounded before they start hiring again. That's why unemployment, for example, is part of the lagging index. So again, these are 3 indicators. The chart that's going to matter this semester that's going to be in every one of your group projects is this one, which combines the CEI and LEI over a shorter period of time. And this gives us a general sense of what's happening to the market. So right now, and you're going to look at this chart in about 3 months, what we care about is that the LEI is continuing to go up, which basically means for late 2013, early 2014, we expect the economy to be generally in a growth mode, given what this index is telling us. And so that is going to influence the stock market. Right? So where you can find this index, as I said, if you go to the website for the conference board, and if you just go to their homepage, then on the right-hand side, there's a link for U.S. indicators, and then there's a link for the leading economic index, and then here's where the press release is. Again, it's updated about once a month. This is the press release through August, so the September 22nd one will come out around the 22nd to 24th, and in the press release is this chart that I just showed you. So again, this is what you'll have to take a screenshot of and put in your final presentations. So the general idea is that we think that the U.S. economy should continue to improve. Question number 2 for the E. What's going to happen to our stock in general compared to the economy? So as the economy gets better, will the performance of the stock get better? As the economy gets worse, will it get worse, or will it change at a different rate than the economy? So as a proxy to answer that question, we are going to look at something called the beta. Okay? So you learned this probably in a previous class, but the idea, and this is an assumption we're going to make, is that stocks in general, stock market, equity markets, tend to go up and down with the economy. So in a better economy, the stock market goes up. In a worse economy, the stock market will go down. So therefore, what we're going to care about is what happens to our individual stock against the economy. So this is a beta, in this case a 5-year beta of McDonald's, right? So we are going to arbitrarily use a 5-year Bloomberg beta to answer the question of sensitivity of a company to changes to the economy, right? And we all know for beta that a beta of 1 basically means that relative to the, in this case, S&P 500 index, a beta of 1 means if the market goes up 1%, McDonald's would go up 1%. A beta of 1 means that the market goes down 1%, McDonald's would go down 1%. Right? Now, Bloomberg, which is the source of the data that we're going to use to calculate the beta, Bloomberg's beta calculates both what they call a raw beta and an adjusted beta. So what they do is they put in all the data points for the last 5 years on, in this case, a weekly basis. They then draw the trend line. The slope of the trend line is the raw beta. In this case, it's 0.469, right? So that's the beta that we're going to use when we try and answer this question. Now, Bloomberg also calculates what they call an adjusted beta. An adjusted beta is just a statistical argument for regression to the mean. So what they do is they put in a regression coefficient. And the regression coefficient is calculated by taking 2/3 of the raw beta and 1, which is the market beta. And then they basically take a weighted average, and that's the adjusted beta. So it just moves it closer to 1. Right? And so there's statistical arguments as to why people do that. And for this class, we're not going to care about that. To answer our question about the E, we're going to look at the raw beta. Right? That's the number that we're going to care about to try and answer the economic sensitivity question. So for McDonald's, for a raw beta of 0.469, what would that tell us about McDonald's economic sensitivity? Yeah.
And it moves about half as much as the market moves.
That's right. Moves about half as much as the market moves. So if the market goes up 1%, McDonald's goes up about 0.47%. If the market goes down 1%, then McDonald's tends to only go down about 0.47% over the last 5 years. So basically, McDonald's is more or less economically sensitive. We'd say less. All All right, and again, think about that intuitively. In bad times, people trade down to McDonald's. In good times, people stay with McDonald's for convenience. So McDonald's is somewhat sensitive to the economy. It's still got a positive beta, but it's much less sensitive than the average company to changes in the economy. So if we think about valuing McDonald's, the changes in the economy are going to be much less important to McDonald's than, say, another company. All right. So you're going to have a homework assignment on Wednesday. So we're not going to have a physical class on Wednesday. I'm going to give you time to go to the Bloomberg lab on Wednesday to complete your homework assignment. All right, it's going to be due on Monday. All right. But one of the things you're going to have to do is I'm going to give you a different company, won't be McDonald's, and you're going to have to go get their beta and do a little write-up about whether or not you think that company is more or less sensitive to changes in the economy going forward. Okay. So in Bloomberg, so here's a Bloomberg terminal. When you log into Bloomberg, what you can do is type in a company's name or ticker symbol to start filtering it out. So let's say we talked about Royal Caribbean last week. Let's say we wanted to look at Royal Caribbean's beta. So we would type in RCL is their ticker symbol, or Royal Caribbean. About halfway down the screen, it will start filtering out the companies associated with this ticker symbol. US means it's a US company, right? So US Stock Exchange, CN Canada, etc. And then equity is their stock, corp is their debt. Since we're doing equity analysis, you will look at US equity. So RCL US equity. It'll then bring you to the main equity analysis screen. Now you have to remember that Bloomberg was a database created in the 1980s, before mice and graphical interfaces were around. So the way that Bloomberg was originally designed is in order to move quickly between the screens, they set up the concept of keyboard shortcodes. They're 2 to 4 digit shortcodes that generally will get you to a specific screen. And because of the legacy nature of the system, they still exist in the software today. So for example, when I mentioned last week about getting Bloomberg certified, one of the things you'll learn is the Bloomberg shortcodes. So for example, if you're sitting there talking to somebody in an interview, they'll start probably popping out some of the shortcodes to see if you really know Bloomberg, because they'll say, what does this EQRP, for example, shortcode mean? The one that we're going to care about here today is called beta. Very simple. You want to do a beta analysis from the equity screen, type in beta, B-E-T-A. And that will calculate a real-time beta for your company. In this case, regressed against the S&P index. Matter of fact, you can change these things. By default, Bloomberg does a 2-year beta. We want a 5-year beta. Again, arbitrary. When I was a student at the Wharton Business School, we were given the 5-year bearer betas. That's what we used. And by the way, back then it was the bearer books, because we didn't have a tool like Bloomberg that do real-time beta calculations. So I'm just biased towards 5-year betas. I'm sure there's lots of people that can argue about different time lengths, but for purposes of this class, we're going to arbitrarily use a 5-year beta. So therefore, what I want to do is I want to come into this date range, change that to 2008. Hit enter, and you notice pretty quick, it just added all the other data points, redrew the trend line, and we can see for Royal Caribbean, raw beta, last 5 years, 2.053. So what can we say about Royal Caribbean's economic sensitivity? Yeah.
They're very sensitive to the economy.
That's right. So unlike McDonald's, if we are focusing on the economy and the economy is getting better, Royal Caribbean should do much better as the economy continues to get much better. So again, they're going to be much more sensitive to the economy. And that's what we're really trying to assess here. So for example, if I were doing a portfolio as opposed to an individual analysis, and I thought that the economy was about to change, then a high beta stock I could play in my portfolio if I thought the economy was really about to change direction, either go long or go short based on high beta stocks. Or if I wanted to have safety stocks in my portfolio, then I want a low beta stock. McDonald's would be much more like a safety stock. It's going to have much lower amounts of change relative to the market change. So again, that's the way we want to do the E analysis. Let's just pick another company. What would be another company that we could look at? Different industry. Google. What do you think their beta is? before we looked? Anybody have a thought on that? Think Google's sensitive to the economy or not?
I think it probably is because they get a lot of money from advertising, and companies are going to spend more on marketing.
So Google is ad sensitive. So let's see. So let's look up Goog, U.S. equity, and let's look at their 5-year beta. So 2008, they are almost dead even with the economy, 0.97. So back to advertising. Google is really an advertising agency, and they're basically trailing the economy. When the economy is better, people spend more on ads. When the economy is worse, they're going to spend less on ads. So Google, much more in the middle between the two. They're going to be just kind of sensitive to the economy. But again, that's an important fact because with Google, we need to probably have some cyclicality in their results if we're forecasting very long-term performance. We shouldn't probably have them just a straight line, okay, as the economy ebbs and flows. So that's the E part of our analysis that you're going to do for your homework assignment. Right? Next, I. I stands for the industry analysis. So for the industry analysis, what we want to understand is the industry attractive. And specifically in this class, we are defining an attractive industry as an industry with a positive spread. So ROIC relative to cost of capital. So an attractive industry has a positive spread. An unattractive industry has a negative spread. That's the way we're defining an attractive industry or not an attractive industry. All right, so it's relative to the ROIC of the industry against the cost of capital of the industry. All right? So, skip a couple slides. From the book, McKinsey had done this kind of 40-year historical ROIC analysis of different industries. And what you can see is different industries had different levels of historical ROICs. So for example, between 1965 and 2007, the best historical industries were pharma and software. The worst historical industries were utilities and airlines, and the average industry was probably somewhere around 9 or 10%. So that gives us a sense that not all industries are going to earn the same rate of return. The reason? There's different rules of the game associated with industry. There's different factors that make some industries more attractive and some industries less attractive. So what we want to do is we want to understand those factors of attractiveness. All right, and that's what we're going to do as part of our next exercise. But before we get there, I want to highlight 2 critical slides. This is a very critical slide for this semester. 1, ROIC over time for an industry. What McKinsey did is they took companies across all industries, and they put them into quintiles, 5 portfolios, based on ROIC performance. And they did a buy and hold strategy with these quintiles. And they wanted to see what was going to happen to ROIC over time. Across all 5 quintiles, what you saw, and these are years, is basically there was regression to the mean. This is very powerful to understand when you're doing equity analysis. This is why I know in a decade that Google and Apple are not going to be doing as well in a decade as they are today, because the market is very Darwinian. So the best performing companies tend to trend down over time. Here's the other thing I know. No matter how poorly JCPenney is doing today, they're probably not going to be doing this poorly in a decade, because it's also very difficult to sustain poor performance for long periods of time, because investors will force you to change. They'll either get rid of management, they'll stop investing, companies will go away. But it's a very Darwinian process. So what you tend to see over the long run is regression to the mean. And that's important. It's not saying there can't be exceptions, but the mean is powerful, and the mean is the cost of capital. So over time, even well-performing companies today, and we're talking about big established companies here, tend to regress to the mean over a longer period of time. Second, they did a similar study based on revenue growth rates. And they broke out companies based on how fast they were growing into quintiles. And again, buy and hold strategy. What you notice? Same thing. There's regression to the mean. The difference is the regression to the mean happens much faster. Part of the reason, law of large numbers. So I've been working with a lot of Chinese companies recently, and they get their feathers ruffled when I say that China can't keep growing at 8% a year. And they're like, why not? And I said, law of large numbers. Goes back to this graph, that when you get so big, growing at 8% a year gets harder and harder to do. So 5% growth on a bigger economy is actually pretty good. All right, and that's what people have to understand. So as the China economy starts to slow, it's not necessarily bad in the context that it's based on a bigger base. Well, the same thing is true for a company. Apple's $160 billion in revenue last year. Can Apple keep growing at 20% a year for the next decade? I mean, think about the math associated with that. That's what happens when you become big, is that you tend to regress much faster to the mean. And the mean historically has been around 5 or 6%. Now that includes non-organic growth. That includes acquisitions. If you strip out acquisitions and look at organic growth, then you're probably looking at something like 3%, which is close to GDP for the US companies. So that's the point. In this class, we're going to use about a 3% long-term GDP growth as a proxy for our long-term growth of companies. Right? However, companies themselves can grow faster with non-organic growth, but even so, they tend to regress to the mean once they get larger much faster. So think about sustainability. Is it easier to sustain as a large company? Think of companies more than $1 billion in revenue. Is it easier to sustain high growth rates or higher levels of ROIC? It's probably easier to sustain the higher levels of ROIC because the growth rates regress much faster. Right? So let's go back to this analysis. So here's a screenshot out of Bloomberg. So again, you'll need to take a screenshot out of Bloomberg. So one might ask, gee, how do I take a screenshot out of Bloomberg? When I go back to the beta screen, when we did Google, in the upper right-hand corner of Bloomberg, there's an export button. If you hover over the button, it'll give you the name of the button. When you click export, you can do save screen as file. So it'll create a GIF image of the screen. Save it to a desktop or a thumb drive. So again, you can save it whatever file name you want, but the convention I usually use, Goog was our company, -beta was the screen. So I now have a screenshot of this screen from Bloomberg. Easy way to take it. All right, everybody with me? So one of the screens in Bloomberg that we're going to go to next is called the RV screen. Again, it's back to the short code. So I'm going to go back to McDonald's, MCD, US Equity, and I can either click on the RV screen or type in RV across the top. RV used to be called relative valuation. They've changed it to comparable analysis, but it used to be called RV was relative valuation. RV is a very powerful tool within Bloomberg because it allows you to take a company and quickly compare it against peers across all types of financial ratios. So that's how we're going to compare financially companies against each other. So when we go to the RV screen, it's going to take for McDonald's all of its peers based on a general industry classification service. So everyone's in a government database with an industry classification code based on the hotel, restaurant, and leisure industry. These are the peers. I could go down to a sub-industry classification. If I just wanted to look at restaurants, here's my sub-industry. Right? What we're going to use this semester, though, is I'm going to change my comp source from the industry classification, the generic one, to the Bloomberg comps. Bloomberg comps means that somebody at Bloomberg has actually gone through and edited out a peer group list. So this is a Bloomberg chosen list of peers, which I prefer over the arbitrary industry classification that the government has used for companies. So again, it's just sort of a better way of looking at the peer group. So if I look at the Bloomberg peers, and I can come up here to actions and hide the top section, here are the 15 closest peers to McDonald's. and then here is financial data for them. Now, with this financial data, there's a series of tabs. I can go, for example, to the comp sheet tab, and there's a series of sub-tabs. Sub-tab, profitability. There's all the profitability ratios automatically calculated and adjusted for all these companies. I can go to the balance sheet ratios. There's all the balance sheet ratios for all these companies, right? But this is what's powerful. I can go to the custom tab, and I can create my own tab with my own ratios that I want to see for all these companies. So here's what you're going to have to do for your next homework assignment that's going to be graded. So this is why I'm giving you time in the Bloomberg Lab on Wednesday. We're going to look at the industry spread. We need to know the industry spread to figure out if it's an attractive industry. So what I'm going to do is I'm going to add a column to my custom tab called ROIC for return on invested capital. And then I'm going to hit enter. And it's going to say, what period ROIC do I want? In this case, I want the latest year. So in this case, 2012. So basically give me the latest year, hit enter or return, and it added ROIC, annual ROIC, to my custom template. Then I want weighted average cost of capital, WACC. Hit enter. Choose the WACC, select it. It adds WACC to my template. So I now have ROIC and WACC for McDonald's and all of its peers selected by Bloomberg. Then, powerful statistical function. Select stats. Market cap weighted average. Market cap weighted average weights the ROIC based on the market size of the companies. So bigger companies get more weighting than smaller companies. So when I hit update, excuse me, I now have an industry ROIC weighted based on size, and I have an industry WACC. So now I have, for the fast food industry, I have an ROIC, and for the fast food industry, I have a WACC based on December 31st, 2012. Questions about that? Here's the other cool feature. See this little gear over here in Bloomberg. I can click on the gear, and it gives me two additional options. One, if there's a formula that I can't find in the Bloomberg database, I can create my own formula. So for example, in the last class, somebody asked, gee, does Bloomberg have a formula for spread, ROIC minus WACC? And I said, no, they don't. However, you can create your own. So you can add a formula, and you can add it to your account. It'll save it as part of your account, ROIC minus WACC, if you wanted to. Now, I'm asking you to do it, but just letting you know about a feature of Bloomberg. But here's the more important one. Save as new template. If I save what I just created as a template, so I'll call this my 443 spread, or 443 SPR, I'll save it. Then it'll add a tab here under the custom templates. You might say, gee, why would I want to do that? Well, here's the thing. Let's say I went to Home Depot, and I want to see what Home Depot's industry looks like. Type in HD, US equity, go to the RV screen, go to custom templates. I can now click on my 443 SPR template, select my stats, market cap weighted average, and I now have the ROIC for Home Depot's industry and the WACC for Home Depot's industry. And again, I want it based on the Bloomberg peers. It updates based on Bloomberg selected peers, but again, the template is still there. So what's nice is that you can actually, if you want to create your own custom analysis, not just for this class, but for any class, you can save it. It'll be part of your account in Bloomberg, and then you have the choice of outputting. If you hit output, you can dump it to Excel. And then you got the data in Excel, you can manipulate it any way you want. Or you can take a screenshot, save screen as file, and then you could do Home Depot-RV, and then I have my Home Depot RV screen. So again, it's just a quick way of getting industry spreads. All right. So let's go back to McDonald's. MCD US equity. RV. Source Bloomberg. And then we want custom template, the one we just created. Select stats, market cap weighted average, update. Actions, hide the top section just so it's easier to see. So let's go back to McDonald's. Here's the interesting thing about fast food. These fast food companies, these are big publicly traded companies, average an ROIC of almost 23% and a cost of capital of about 7.6%. Is this an attractive industry?
Very.
Exactly, very. And the reason why we know very is the right answer is we have a sense of historical industry performance, and the best industries over the last 40 years were in the low 20s. So fast food, as boring as it sounds, is a phenomenally profitable industry right now. It's extremely attractive, right? That may surprise you, right? But here's back to the industry analysis. Now we know it's an attractive industry. We got to try and figure out why. Why is fast food such an attractive industry, right? What we're going to do to answer that question is we're going to do a 5 forces analysis. I assume all of you have heard of Michael Porter's 5 forces analysis. You did in a previous class. If you haven't, look it up, right? Because you're going to have to do that for your homework assignment. But basically, Michael Porter is a Harvard Business School professor. He wrote a book in 1984 called Competitive Advantage. And as part of that, he laid out his theory that these 5 industry forces explain industry profitability. And that theory over the last 30 years has kind of stood the test of time. Now, basically, some people argue, well, there's 6 forces, there's a government force, or there's other forces, there's different models. For purpose of this class, we're just going to use the 5 forces. So using these 5 forces, and they're represented here on this slide, we need to explain the profitability of the industry. The 5 forces are this: buyer power. Do our buyers, our customers, have power over us? Do we have power over our customers? Supplier power, same thing. Do we have power over our suppliers? Do our suppliers have power over us? Substitutes. Are there substitutes to what we do? How viable are those substitutes? So for example, if I were taking a plane to New York, one substitute might be Amtrak. Another substitute might be, whatever the bus thing is called. What do you call the big bus?
Megabus.
The megabus, right? So that would be a substitute to flying to New York City. That's very viable. But if I'm flying to Los Angeles, megabus is probably not a viable substitute. Neither is Amtrak. So the substitutes can become more or less viable depending on what you're looking at. Entry barriers. Is it easy to get into this industry? Is it hard to get out of this industry? That can affect profitability. Because if it's hard to get out and you try and drive a competitor out of business, they become like a caged animal. And then they can't leave the industry, so they start doing really bad things. That's something we have to understand. Or if it's hard to get in, that can make the industry much more attractive. And then finally, the intensity of the rivalry. How much rivalry exists amongst the peers? Is it more of a friendly rivalry or almost monopolistic competition? Or is it cutthroat, intense rivalry? What's that level of rivalry? Supply-demand affects that very much in the short run. So those are the 5 forces. Here's our scoring mechanism. So what you're going to do for your next graded homework assignment is you're going to get out Excel and you're going to score the industry's 5 forces and the overall, all right, in Excel. So here's what we did in the previous section. I'll clear out my data points. But you're basically going to create a little spreadsheet model that looks like this. Here's the 5 forces: buyer, supplier, entry and exit, substitutes, rivalry, and overall. And what we're going to compare is the current performance of the industry and the performance in 5 years, 5 years from today. Right? And what we want to understand is that the performance of the industry today is going to be based on the 5 forces, and how the 5 forces change over time will give us a sense of the industry performance in 5 years. So the example I gave the last class is I used to work with a chemical company called Dow Chemical about a decade ago. And when I worked with Dow Chemical, they looked at their internal business cases. And these are basically, when people ask for money internally, it's called a business case. And what they did is they looked at business cases that had been approved. So these are the ones that were submitted and approved. And they said, over a 5-year period, how well did we do based on what was promised versus what was delivered? The average business case only achieved 50% of the benefits that were promised. And these are the ones that were approved. Well, that's pretty scary if you only get half the benefit that you actually promise, and they wanted to figure out why. So the answer to the why was that the number one reason that they only got half the benefits in their business cases is they had overestimated their revenue and they'd overestimated the price almost every single time that they would actually sell. And so what they did is they hired a consulting firm called Maricon to come in and help them understand why they were so bad at forecasting. And what Maricon basically said is, look, the problem with your forecasting is you're using a traditional method that never works. And what they did is they were taking price today and they were just adding inflation over time. And then they were taking cost today and they would put in cost savings over time. So essentially what would happen is you get almost like 2 different directions. Your prices would go up, your costs would go down, your margins would improve, and that was a fantasy. It never happened. But that's what they were doing when they were putting together their cases. So what Maricon argued was use ROIC-based forecasting. What Maricon said is, look, if your ROIC is 10% today, and nothing about your industry changes in 5 years, your ROIC is going to be 10% in 5 years. So therefore, if your costs go down, guess what? Your price is going to go down. When they started using ROIC-based forecasting, they got almost dead on with their forecast versus what was happening in the real world. And it really opened my eyes as an outsider to this whole process that Maricon was showing them as to why we need to do ROIC-based forecasting when we analyze stocks, because the same principles apply. So that's what we're going to do here in this little industry analysis exercise. So here's the starting point. We have a sense by looking at this data for the general ranges historically for U.S. companies of good and bad ROIC. We are also going to use an arbitrary 5-point scale that has meaning to this class. In our scale, a 3 means 0 spread. A 3 means you're earning your cost of capital. A number above a 3 going to a 5 means you're earning well above your cost of capital. A number below a 3 means you're earning below your cost of capital. 5 is the best, 1 is the worst. Well, what's best? Low 20s. That's a 5, historically. What's worst? 5% or below. That's a 1, historically. And earning your cost of capital is about a 3. So, this number has a right answer, and this number is observable because what we're going to start out with for McDonald's, and I'm going to give you a different company for your homework assignment, which is why you're going to have to go to the Bloomberg lab to go get all this data. But basically, what can we say about the fast food industry that McDonald's is in on a 1 to 5 scale? This is probably as close to a 5 as you're going to get out there. This is a 5. This industry is doing phenomenally well. Does everybody see that? How I'm coming up with that? So, for the overall score in our little 5 forces table, we're going to call it a 5. Now, what we have to then explain using these 5 forces is why is it a 5? We're going to use the same scoring methodology for each force. So step 2, explain each force. Right? Now, if that force helps the industry have a positive spread, a number above a 3. If that force hurts the ability for the industry to have a positive spread, a number below a 3. So the way to think about it, if that was buyer power was the sole force and we scored it a 3, that means this industry would be earning about 8%. Right? But this industry is earning 23%. So what do we think about the power of the buyers? So it's not, is the buyer power strong? It's, does buyer power allow this industry to make a better profitability? So a 5 of buyer power means actually the buyers don't have a lot of power. It means it's easy to make money. That's the way we need to think about the scoring in this industry. Now, to help you as you go through this process, this is a real class. We deal with the real world here. So, has anybody used Smith Apps before? If you go to smithapps.rhsmith.umd.edu and log in, in the finance folder, there's an app called IBIS World, which I was in earlier. I'm hopefully going to be able to get back into it. I'm going to get back into IBIS World. What IBIS World does is IBIS is a company that writes industry research reports. Basically, the IBIS World report, some analyst in the real world has actually written a 5 forces analysis. So because we're doing a real world class, rather than trying to write your own, you're perfectly able to use real world reports to help you with the 5 forces analysis. So if the industry I give you, you don't know anything about it, you're welcome to use IBIS World. Here's the one caveat. You can't plagiarize. So if you use the IBIS World report, you got to cite the IBIS World report. You can't say it's your own unique work. But it's perfectly acceptable to cite real-world reports as answers to your questions in this class. Right? Because again, we're dealing with real-world data here. This is the applied part of the class. So in IBIS World, what you do is you can just type in a company or an industry, in this case McDonald's, hit go, and then it'll show the industry reports that they're part of, in this case fast food restaurants, and then this is the fast food report. I can save it as a PDF, or I can just go to the different sections of the report. By the way, the industry outlook and the industry performance, this is basically where they've done the 5 forces analysis. Right? So the point is, if you don't know anything about the fast food industry, you can go here to get their assessment, and they also include a 10-year assessment into the future as well. So they do a current and a future. So that's something you'll probably want to do for your homework assignment. So let's just assume we know a little bit about fast food. I'm sure you guys at least are customers. So let's just try and do this real quick. What do we think about buyer power in the fast food industry? Who has the power? McDonald's and Taco Bell and Chick-fil-A and Chipotle, or us?
They do. There's so many of us. So every person has so little power. Each person has so little power.
So you say the buyers have the power.
I think the companies, McDonald's and Taco Bell have the power.
Why?
Because there are so many customers that if I decide I will never eat fast food again, what do they care?
Because there's just too many of us and too few of them. Now we're talking about national fast food chains here, and brand is very important as well. Yeah.
Because if one company's going to price their food lower than the customer is going to go to that.
So that would actually hurt the ROIC of the industry. If you're saying there's a lot of rivalry and they can undercut each other with price, that could really hurt their ability to make money. Yeah. All right, so give me a score for buyer power, 1 to 5. All right, if you said 2, what you're basically telling me is this industry should be earning around 6% ROIC.
Why is that? Why is it 2 go to 6%?
Well, I'm saying a 3 means cost of capital, and the cost of capital for this industry is 7.6%. So a 2 means below 7.6%. So I'm saying 5, 6%, somewhere in that range. You're saying this industry is earning less than 7% with a 2, solely based on buyer power. Now, I'm not saying the other forces can't offset that, but I guess that's the real question. Is this industry that competitive? And I ask this question very honestly, like, how much is a value meal at McDonald's?
$6.
How much is a value meal at Chick-fil-A? How much is a value meal at Wendy's?
About the same.
are they really competing on price? And do we really have that much power that we're exercising over them? So it's not saying that we couldn't exercise a lot of power, but are we as an industry exercising that much power? Because if you really think about it, there's probably only about 15 or 20 national fast food chains. And for fast food, there's not really that much choice, and brand is very important. And we are brand loyal people. Because I bet when you think about fast food, there's already a brand in mind that you're going to think about going to when you go there. Right? And that benefits them, which kind of is offsetting some of this buyer power. So I don't disagree with the point that we have a lot of buyer power. Problem is I don't think we're really exercising it right now. And the reason I say this is because what we have to explain is the fact that this industry is making 23%. And there has to be a reason why. And I don't think the buyers are hurting them that much because the buyers are an important force. So I might actually say that this is probably more like a 3.5 or a 4. Again, there's no right answer here, but this is what you're going to have to think through as part of your results. You're going to practice doing this on a different industry. What about suppliers? Suppliers of the fast food industry would be, cattle, cows for meat, chicken, pork. It would be lettuce, tomatoes, the farms for the condiments. Yeah.
Oh, I imagine that any given company, say McDonald's, buys everything for all of McDonald's.
Yes.
And so if I'm a farmer, I'm going to be very scared to haggle with them because if McDonald's says, you know what, never mind, I just lost, I can't even imagine how big that order could be.
That's right. So there's few huge companies, relatively small commodity suppliers. They probably are not exerting a lot of power. And actually, the other thing McDonald's is doing is they actually have their own farms now. So McDonald's is vertically integrating to even control some of their supply chain. And that means it's even harder to sell to McDonald's because McDonald's is like, hey, I'll just grow it myself. So the point is, I think the suppliers don't have a lot of power. I think that's helping the industry profitability right now. I might even call that a 5. Right? Is it easy to become a national fast food chain? Has anybody heard of, I think the best fast food chain out there is called In-N-Out Burger. All right. How many of you have never heard of In-N-Out Burger? How many of you have never been to an In-N-Out Burger? All right. It's about a third to half of the class for those of you listening on video. But the point of the story is, the reason why is because they're in the West Coast. Even as successful as they've been, their family-owned business, it's hard for them to expand nationally. It's very costly. And they've been doing it sort of a state at a time. Same thing, Five Guys, which is doing pretty well, is just now branching out of the mid-Atlantic, northeast part of the U.S. So again, it's hard to build these national chains with national advertising, national reputation. I think it's hard to do it. So therefore, I think that allows these national chains to make more money and to build that brand. I mean, think about how many McDonald's commercials you hear on the radio or see on TV and how much it would cost to challenge that as a competitor. So again, I think the entry and exit barriers are pretty strong, and that's probably another reason why it's easy to make money for this industry.
Why does exit barrier help an industry?
Well, it could hurt an industry. Well, put it this way. If it's easy to leave and easy to shut down, then it helps the industry. Because the second the going gets tough, people can leave.
And what would you say about exit barriers in the fast food industry?
I think that the exit barriers are pretty easy. I think it's easy to shut them down. I think it's harder to build 4,000 restaurants. That's the entry barrier. And think about how much cash in today's world that people are going to give you to go up against the established chains. So I'm just saying, if you had the venture capital competition and you went in there and you came up with the next big food to be national food chain, they'd probably laugh you out of the room. All right? And a couple of reasons. One, you don't have the experience, but two, like just building something that's going to challenge one of these chains, it's going to cost a lot of money. And so it's going to be hard to break into this industry. Entry barrier.
So you don't look at each of them individually. You say...
this is industry as a whole.
No, but I'm saying in terms of entry and exit, you're saying is entering relative to exiting hard or easy?
Well, think about it this way. One of the reasons why airlines have been such a bad industry is the bad players can't shut down. That the local governments and communities do not want those airlines to go away and serve their cities. So they're always complaining to the FAA and the airlines themselves, the regulators, anytime somebody wants to cut a route. So it's not easy for the airlines to shut down stuff. Matter of fact, Amtrak is running through that right now. Amtrak is very profitable in the Northeast Corridor. Amtrak is losing billions of dollars because they're serving places that nobody goes to anymore. And the problem is that the government, which is yelling at Amtrak for losing money, won't let them stop service to other routes. Look at the Postal Service. You know, the fact that we're clamoring to shut down Saturday mail is the government's preventing them from doing that while they're telling them to cut all these employees. So I'm just saying barriers to exit. Those can be prominent in some industries more so than others. You're going to ask a question?
Yeah, barriers to exit is also probably liquidity, right, which is always a bad thing.
It could be that as well. Absolutely. So that's what I said. It could vary by industry, but that's what you have to think about. Is it easy to get into? Is it hard to get out? Right? Substitutes. Are there substitutes for fast food today? What would be an example of a substitute for fast food? Yeah.
Cooking yourself.
Cooking yourself. Novelty. Novelty for our generation. But seriously, that is a substitute. What's another one? Yeah.
Restaurants.
Going to more of a sit-down restaurant. What would be another substitute? Yeah.
Frozen food.
Yeah, frozen foods. Or increasingly at the grocery stores, the takeout sections of the grocery stores are essentially fast foods. You know, look at like a Wegmans, if everybody's been into one of those, all the stuff that they offer. So the point of the story is, are there substitutes out there? Absolutely. How much power do they have and how much are they hurting the fast food industry today? Yeah.
I'd say it's a great way now because considering the economy won't come back, spending a lot of considering that fast food isn't expensive.
So
like,
there's a perception fast food's cheaper.
yeah, and also you also want locations, so like a 7-Eleven.
So it's the convenience and cost factor that hurts some of the other substitutes. So give me a score for substitutes.
I'd still say there's a lot, so around 5 or so.
Well, 5 basically means the substitutes are having almost no impact.
Oh, no, okay, so that was much lower.
So maybe like a 3. So substitutes could be hurting them if they were the only force, but the other forces are kind of trumping them. Again, we could agree or disagree, but that's what we're going to have to come up with a point of view on. All right, rivalry. Is there that much rivalry amongst the fast food companies themselves? Particularly on price. Think about price.
Not much. They're all about the same price.
They're all competing on types of food. So for example, Taco Bell is now competing on the Dorito Taco Bell sandwich. They're not trying to cut it down to the lowest price. That's why I asked earlier about what's the price of a value meal. If you think about it, the price of a value meal at a McDonald's, a Chick-fil-A, a Burger King, a Wendy's, and I can't think of the other national fast food ones, Panera or a Chipotle. Chipotle burritos are not cheap. So that's what I'm saying. They're not really competing on price. They're competing on other factors, choice, quality, etc. It's hard to put quality and Taco Bell in the same sentence, isn't it? But in any event, they're not probably being overly aggressive on the rivalry. So I'm not saying there's not rivalry, but I would probably put it at a 3.5. Right? Now, here's the point. It doesn't have to be a straight average. It has to be sort of one of the factors. But here's the other question. What if my scores were this? When the TAs grade your assignment, would that be a correct answer? Why is this not a correct answer?
How could your overall be higher than any one?
That's right. How can your overall be higher than any one of those? And that's one of the things you're going to struggle with, because you can make a case for every one of these forces that it shouldn't be a 5. Yet, that's what I'm saying. Observably, this industry is still making 23%. There's got to be a rationale for this happening. So you have to come up with something that explains the profitability of the industry that we're looking at. Does that make sense? So, as I said, maybe for us, it was the supplier power and the entry and exit barrier that kind of trumped everything. Yes?
Are we supposed to provide explanations for these numbers?
Yes. So on your homework assignment, you're going to have to get the screenshot. You have to score the overall based on the screenshot, the RV screenshot. You're then going to have to give your numbers, and then you're going to have to write a couple paragraphs with your rationale. This is going to be part of your homework assignment. Yes?
So justification for rivalry 3.5 is that it's insignificant?
Well, what I'm saying is that the rivalry is there, and it's not that strong.
Okay.
So there is rivalry. I'm not saying that people are fighting, because I can go to different fast food industries, different choices, different companies. But I don't think they're really competing on price. Like, I don't think we're going to get the $1.99 special at Wendy's anytime soon. Like, they're not being cutthroat aggressive with price. That would really cause everybody to match the price, and then everybody loses money. Because even the dollar meal at McDonald's isn't a dollar meal anymore. It's the $1.49 meal. And what they're also doing is the sizes of the food. The portions are now smaller. So it used to be $1 for a bigger sandwich. Now it's $1 for a smaller sandwich. So they're basically cutting back in other ways to kind of get essentially higher prices. Because like I said, they don't really want to compete on price as an industry. That's why I'm saying the rivalry is not that strong. But there is still some rivalry in the industry.
If there was no rivalry, it'd be a five.
There's no rivalry, I'd call it a 5. If they were almost like a monopoly, and that's where you're just going to go. Or if they were extremely collusive. Think Coke and Pepsi. Or Apple and Android to some degree. You know, all the phones that Apple and Samsung sell cost about $600-700 if you just buy the phone unsubsidized. You know, all the new high-end phones are $199 for the smartphones. So you don't really compete on price. You then compete on other things besides price, and you can make a lot of money. So 90% of the smartphones out there are either going to be Apple or Samsung phones, and they're all going to be $600-700 without subsidy. So you don't buy an Android phone because it's cheaper. You buy it because of other factors, right? And that's really the point of the market. Even when Apple came out with the colored phones last week, the whole point of the different colors is that what? They're still expensive, but you choose based on, hey, I can get this or that. Matter of fact, I saw an article where somebody talked about the reason they added color to their phones was that they didn't update the iPod Touch. That's going away. And what they really want to have those phones targeted are the teenagers. So the teenagers that now get the touches want phones. So basically they're moving them to those phones. So that's actually the target for the phones that are pink and green and yellow and whatever. They're towards kids because they're not going to update the iPod Touch anymore. That's the rumor that I saw circulating last week. Made sense to me. But so again, here's the next part of your homework assignment. How are these forces going to change in 5 years? So 5 years from now, is the buyer power going to be about the same, stronger, or worse? What do you think?
Reason for the change. I would think it stays the same.
All right, so if you don't think there's a reason for this change, stays about the same. Suppliers, are they going to be stronger in 5 years?
Weaker, if anything.
So about the same power. Entry and exit, is that going to change in 5 years? Substitutes, are they going to be more viable in 5 years? Possibly. Rivalry, is it going to get more intense in 5 years? Probably not. So here's what we've said. Maybe in 5 years, because the substitutes get stronger as we go towards healthier alternatives, 4.5. So what am I really saying? ROIC, which today is about 23%, in 5 years, I don't know, 18 to 19, something like that. That's what we're really trying to do. And we're going through a process to get there. So the process is look at the observable industry spread, try and explain it, try and explain the changes in the forces, and infer what will happen to the industry ROIC in 5 years. Couple paragraphs. So that's what you're going to have to do as part of your homework assignment. Questions? Week from today. So what I'm doing is, because you'll need to go to the Bloomberg lab, and this is really the first time you guys have all had to use Bloomberg, I'm going to give you class time on Wednesday, so there will be no class in this room. What you'll need to do is to go to the lab and get these screenshots and get the data and get help from the TAs if you need it, because they have office hours this week. And remember, my TAs, both of them took Brent and I'm blank on my other TA. My apologies, this is being recorded. My two TAs, and you're wonderful, are, anyways, they took this class, they know Bloomberg, and they can help you. Yes?
What percent of ROIC did you say is a 3 for overall? So you know,
Well, what I'm saying is, for a 3, question is, does it earn the cost of capital? So a 3 would be right around 7.6% for this industry. Different industries could have different spreads. Brittany Flack. Brittany, sorry. Took me a second to remember your name. It must be the medication. All right, so Brittany and Brent are the TAs. All right, questions about any of this? Here's the third part of your homework. The C, competitive advantage. We are going to define competitive advantage differently in this class than you've probably had it defined for you in other classes. Our definition of competitive advantage is relative to the ROIC performance of the industry. In order to have competitive advantage, you have to have an ROIC greater than your peers. Now, ideally, it should be a spread greater than your peers, but to make it simple for this assignment, ROIC greater than your peers, because most companies are going to have pretty similar ROICs. So to keep it simple, we're going to do it based on ROIC. But technically, we should do it based on spread. Okay? But basically, in order to have competitive advantage, you have to do better than the average ROIC of your industry. So the way you need to think about ROIC is some of the ROIC is based on the industry you're in. So if I think about McDonald's, if I'm a fast food company, I should basically earn somewhere around 22.8%, just because I'm a fast food company. And then my ability to execute is going to be plus or minus that. So my competitive advantage, if I'm good, I can make more than 22%. I can make more than the average of the industry. If I'm bad, I'm going to make less than 22%. So let's be specific based on this list. Does, pick a company on here, Buffalo Wild Wings, do they have competitive advantage? No. Why don't they have competitive advantage?
Much less than the average.
That's right. They're earning 15% in an industry that makes almost 23. Does Buffalo Wild Wings create value?
Yes.
Yes, because they have a 9% cost of capital and they're earning 15% ROIC. So they're creating value. They just don't have advantage. As a matter of fact, what I would argue is Buffalo Wild Wings is in a really good industry. They're just not doing as well as the rest of the peers. So to some degree, they're underperforming on a relative basis. Yes?
Well, if you look at Domino's, they have 74%.
Absolutely.
I think that outlier kind of skews the average.
Well, remember, it's based on size. This is market cap weighted average. So they also have a relatively small size of 3.6 billion. Meaning most of this industry is going to be McDonald's, Yum, and Starbucks, and to some degree Chipotle, because we're market cap weighting averaging the industry. But Domino's themselves right now is doing really, really well. Absolutely. They have clear advantage in what they do, particularly when you compare them against Papa John's, which Papa John's is doing a little better than the industry. So you say they have a little bit of advantage too, but Domino's is very clear. What about Yum? Do they have competitive advantage? They do as well. So what you're going to have to do is answer the question, does the company have competitive advantage that I give you? And write a little blurb qualitatively on why. Why do you think Domino's is doing so well if I gave you that in the industry and that company? What's our answer for McDonald's? Does McDonald's have competitive advantage?
So you're just right there. You don't have an advantage over this.
Well, right there is 20% in an industry making 23. So they're almost right there.
Slight disadvantage.
Exactly. McDonald's is in a good industry, and now they're the biggest player in the industry. Right? So I'm not saying they're not doing well, but they're not doing that much better than everybody else. Matter of fact, they're doing a little bit worse than the average player in the industry. So McDonald's doesn't really have competitive advantage right now. Now, it doesn't mean that if you didn't talk to McDonald's, McDonald's wouldn't tell you they have competitive advantage. But our definition is different. Our definition is out-earn your peers. That's consistently do that. That's competitive advantage. So I'll do one more quick example. Let's pick a completely different industry. How about airlines? Let's look at United Airlines, United Continental. And then I'll go back to the RV screen. Again, I'll use my Bloomberg peers. And then I will use my custom template, 443 spread template we just did. Make sure I put my market cap weighted average. How are the airlines doing? Really well. Almost 21%. This is not the airlines historically. This is the collusive industry. All right, this is when they've all consolidated, and now there's 4 major airlines. and they're no longer competing on price. In fact, there was an article in the USA Today yesterday that said the worst time to buy airfares is over the weekend, because they always raise airfares on the weekend because they know you're at home shopping for airfares. The best time to ever shop for airline tickets is Tuesdays, because that's when the fare sale starts. So never buy tickets unless you absolutely have to on a Saturday or Sunday, because their reservations are geared to have the highest prices on Saturday and Sunday. But the point is, that's the point. They all know this now. They all do it. They're colluding together to maximize profitability. And you're seeing that in the fact that now this industry is making a lot of money. Does Alaska Air, or even better, Southwest, everybody's favorite airline, does Southwest have competitive advantage? No. Southwest is now the worst performing airline out there, which is ironic because there are Harvard Business School cases about them and how well they've been doing, right? So that's the point, is that what we care about is observable performance in the industry today. So is the airline industry attractive? Yes or no? What would we score it? Probably close to a 5, 4.5 or a 5. And if you want to get more specific and say 4.6872, great. All right. But basically, very, very attractive industry. Who's really doing well in this industry? Who has the best competitive advantage of these publicly traded peers? It's like Delta. Delta's doing really well right now, right, on a financial basis. So Delta's got some clear competitive advantage, even in an industry doing well, and probably one of the reasons, as the largest market cap of any airline, that this industry ROIC is a little bit higher, because it's weighted to Delta as well. Does that make sense? That's the C component of your homework. So, a couple things as you're leaving. EIC is going to be the assignment this week. So don't come to class on Wednesday. I'm giving you the Bloomberg lab time to do this. Now, here's the thing. I'm going to ask that this room be open on Wednesday so you can use the Bloomberg terminals in here in addition to the ones on the first floor. All right? But if you come to me on Sunday and ask for an extension, I'm not going to give you one, because it's due a week from today. I'm giving you class time to come in and do it. So there's really no excuse for not doing the homework assignment. So what's going to happen is I'm going to give you another company in another industry. You're going to have to go into Bloomberg, get the data for beta. You're going to have to get the data for the RV screenshot. You have to take screenshots of those, hand them in. If you want instructions, go back to, I'm going to post what we just did today, record this and say this is a video. So it'll be a reference, including how we actually created the screens. You're going to have to do a write-up. These are all going to be explained on Elm's Canvas. So this is the assignment that's coming up. Yes?
Are you giving specific companies to each certain person?
No, it'll be one for all 4 sections of the class. So everybody on the same industry, everybody on the same company. Again, if it's something you're not familiar with, you're welcome to use IBIS or Hoover's or other tools. Just cite if you quote from them. So don't plagiarize.
Are these rooms open on weekends or not?
No, these rooms are not open on weekends. So again, I'm going to make sure or ask that they open them up on Wednesday at least for this lab. And the lab downstairs is generally open Monday through Fridays. All right, last question.
The write-up is just like, what are your...
A couple paragraphs. You're going to submit it on Canvas, so it'll be electronic, but a couple paragraphs. All right. So last but not least, if you're not in a group, please let me know, because I need to get you in a group. Otherwise, have one group member send me an email with your group members before Wednesday. And then each group, one member should sign up for StockTrack. And again, StockTrack trading sign-up instructions are in the syllabus. StockTrack trading starts on Wednesday. Goes over the next 3 months. All right, we'll see everybody 1 week from today.